Disclaimer.
Here's what just happened. You're watching silver climb to $84 an ounce, the highest price in over a decade. Your portfolio's finally recovering. Mining stocks are soaring. Physical dealers can't keep inventory on shelves. Then, in just 48 hours, everything collapses. Silver crashes to $74. Your mining stocks plunge 5% in a single session. But here's what should grab your attention. While you're watching your investment bleed, institutional money managers are backing up trucks to buy physical metal at these discount prices. What if I told you this wasn't a market correction? What if this was engineered, predictable, and documented in regulatory filings weeks before it happened? And what if the same Wall Street banks that orchestrated this crash are now positioning for silver to hit triple digits by the end of this year? Welcome to the most sophisticated wealth transfer in commodity market history, happening right now as you're reading this. And it all centers on two events converging in January 2026 that most retail investors never saw coming. Let me walk you through exactly what's happening to our investments, because the numbers tell a story that financial media is not connecting for everyday Americans trying to protect their wealth. On January 1st, China implemented export controls that changed the global silver market forever. The Chinese government elevated silver to strategic resource status, placing it in the same category as rare earth elements that China has already weaponized against Western industries. According to official Chinese customs data reported by CNBC, only 44 companies now hold approval to export refined silver from Chinese territory. This matters because China controls between 60 and 70% of the world's refined silver supply, as documented by industry research firm Ainvest. Think about what this means for your purchasing power. China just turned off the tap controlling more than half the world's silver supply during what is already the 7th consecutive year of supply deficits. But they timed this move with surgical precision because they knew something else was about to hit the market. Between January 8th and January 15th, over $5 billion in silver futures are being systematically dumped on the market. Not because of fundamentals, not because demand collapsed, but because of something called the Bloomberg Commodity Index rebalancing, a mechanical process that happens annually and forces passive investment funds to adjust their holdings regardless of market conditions. Here's where it gets interesting. According to data published on Yahoo Finance and reported across trading platforms like StockTwits, this rebalancing is slashing silver's weight in the index from 9% down to under 4%. That's more than half of silver's representation being eliminated in 2 weeks. JP Morgan's commodity analysts, in notes obtained by financial media outlets, called this event dramatic repricing lower, because approximately 13% of the entire silver futures market has to be sold during this narrow window. Pop quiz. What happens when you force sell 13% of any market in 14 days? Especially when that market is already in its worst supply deficit in modern history. You create exactly what we witnessed in those 48 hours. A controlled demolition that has nothing to do with silver's actual value, and everything to do with mechanical selling that sophisticated institutions saw coming from miles away. Let me put this in perspective with your own portfolio. If you own shares of SLV, the most popular silver ETF, you just watched passive index funds dump positions alongside you. If you bought silver mining stocks near the top, you saw companies like First Majestic Silver and Pan American Silver drop 4 to 5% in single trading sessions, as documented in financial content feeds tracking mining sector performance. Your investment vehicle treated silver as a number on a spreadsheet that needed to be rebalanced, not as a strategic metal in historic shortage. But here's what Wall Street institutions understand that retail investors don't. The physical silver market and the paper futures market are completely disconnected right now. While COMEX futures traders were panic selling to hit their index targets, physical silver dealers reported premiums spiking, according to wholesale market data tracked by multiple financial content platforms. In Shanghai, physical silver bars were trading above $80 per ounce, while New York futures crashed through $74. Have you noticed that disconnect? Paper contracts saying silver is worth $74 while actual physical metal can't be purchased for less than $80 in the world's largest consuming market. That's not a spread. That's a broken pricing mechanism revealing that paper markets are losing their ability to discover the real price of scarce physical commodities. According to Federal Reserve monetary data, there are roughly 100 paper ounces of silver traded for every physical ounce that exists in deliverable form. The futures market has become a casino where bets on silver price movements dwarf the actual metal available for delivery. And China just looked at that casino and said, "We control most of the physical supply, and we're implementing strategic export restrictions effective immediately." Let that sink in for a moment. Our financial system created a derivatives market that is 100 times larger than the physical commodity it's supposed to represent. Then the largest supplier on Earth restricted exports during a supply crisis. timing it perfectly with forced mechanical selling that institutional money knew was coming because it's published in index methodology documents every quarter. Think about this scenario. You're a commodity desk analyst at JP Morgan, Goldman Sachs, or Citigroup. You read the Bloomberg Index rebalancing schedule published in November 2025. You see that silver weight is being cut in half starting January 8th. You also watch China debate export control legislation throughout December. You know the confluence of these events will create forced selling in paper markets while physical supply gets restricted. What do? You position ahead of the crash. You let retail investors panic sell during the 48-hour plunge. Then you accumulate physical metal in allocated storage positions at artificially depressed prices, knowing that when index selling completes mid-January, the supply reality takes over and prices have nowhere to go but up. This is exactly what's happening in our markets right now. The crash from $84 to $74 was onto market rejecting silver's fundamentals. It was Wall Street shaking weak hands out of positions before supply constraints force prices to levels that will make $84 look cheap by comparison. But here's the part that should concern every American with retirement savings or investment accounts. This wealth transfer isn't just happening in silver. It's a template for how sophisticated institutions exploit mechanical market structures and strategic resource controls to extract wealth from everyday investors who don't have access to the same intelligence, the same positioning, and the same understanding of how modern commodity markets actually function beneath the surface. The question you need to ask yourself isn't whether silver crashed. The question is whether you understand why it crashed, who knew it was coming, and what happens next when $5 billion of forced selling stops in exactly 1 week, while China's export restrictions just started creating permanent supply shortages in a market already running 7 consecutive years of deficits. Because what comes next is where fortunes are made and lost. And Wall Street is betting that you'll stay focused on the crash instead of understanding what caused it and what it means for silver prices over the next 12 months. Now, let me show you the hard evidence that proves this is not speculation. It's documented institutional positioning backed by physical market data that Wall Street doesn't advertise on CNBC. Start with the vaults themselves, because that's where the real story lives. COMEX registered inventories, that's the silver actually available for immediate delivery to futures contract holders, are down 70% since 2020, according to warehouse data tracked by FX Street and multiple commodity research platforms. 70%. Think about your retirement account losing 70% of its value and try to imagine that being considered normal market conditions. But it gets worse for anyone believing paper markets still control silver pricing. London vaults, which handle the majority of institutional silver storage for European and Middle Eastern buyers, have lost 40% of their holdings over the same period. Shanghai vaults are sitting at decade lows with only 30 to 45 days of accessible reserves at current consumption rates, according to Shanghai Futures Exchange data compiled by FX Street and commodity tracking services. Here's what should terrify anyone holding paper silver positions. While COMEX futures were trading at $74 during the crash, physical silver in Shanghai, where actual metal changes hands for industrial use, was trading above $80 per ounce. That's not a small premium. That's the physical market telling you that paper contracts have lost price discovery credibility in the world's largest silver-consuming economy. Have you ever wondered why that disconnect exists? It's because China's industrial manufacturers need actual silver for solar panels, semiconductors, and electrical components. They can't settle their production lines with a COMEX futures contract. They need deliverable metal, and they're paying real-world premiums that expose how artificial our paper market pricing has become. JP Morgan didn't just observe this crash, they quantified it with precision that proves they saw it coming. According to commodity desk analysis reported across financial platforms, including Yahoo Finance, JP Morgan calculated approximately 13,000 COMEX silver lots being sold during the index rebalancing. That represents 9% of total open interest being liquidated in 2 weeks. Citigroup analysts estimated the total outflows at $6.8 billion, as documented in research notes tracked by Aparna Decor's and Yahoo Finance commodity coverage. Think about the mechanics here for a moment. When you know exactly how many contracts must be sold on precisely which dates, and you understand that this selling is mechanical rather than fundamental, what do you do if you're managing institutional money? You position short ahead of the event, let the index funds execute their forced selling into your buy orders, then flip long after accumulating positions at artificially depressed prices. It's not market manipulation, it's exploiting publicly available information that retail investors either don't see or don't understand. But here's where it gets really interesting for anyone paying attention to how exchanges protect institutional players. The CME Group, which operates COMEX, raised margin requirements multiple times during this period. According to exchange notices tracked by Aparna Decor's and Yahoo Finance regulatory filings, Raising margins means traders need more cash collateral to hold the same futures positions. Pop quiz: who gets hurt most when margins increase during a price crash? Retail traders and smaller hedge funds using leverage, forced to liquidate positions to meet margin calls. Who benefits? Large institutions with deep cash reserves who can maintain positions through volatility and buy the liquidations at distressed prices. The exchange essentially helped institutional players shake out leveraged positions right before the mechanical selling hit its peak. Now let me show you what the smart money is saying behind closed doors, because these are not permeable promoters. These are analysts whose careers depend on accurate forecasts for institutional clients managing billions in commodity exposure. Gold Silver's Mike Hibbard, whose analysis is followed by institutional precious metals traders, expects silver to exceed $100 per ounce in 2026, with some forecasts reaching $150 to $175. According to precious metals research compiled on silver price predictions platforms and commodity analysis sites, these targets are based on the 7th consecutive year of supply deficits, solar and electric vehicle demand consuming 60% of annual production, and a 40-year cup and handle technical pattern that projects 700% gains from breakout levels. But here's the critical detail. These analysts emphasize that financial media ignores. These price targets only activate after the index selling completes mid-January. Wall Street wants the mechanical selling finished, weak hands shaken out, and physical accumulation completed before supply reality forces the next leg higher. Think about this from an institutional portfolio manager's perspective. You manage a billion-dollar commodity fund. You read analyst research predicting $150 silver based on supply deficits and Chinese export restrictions. You also know that $5 billion of forced selling hits the market January 8th through 15th. Do you buy at $84 going into that known selling pressure? Or do you wait, let the market crash on mechanical liquidation, accumulate physical at $74, then ride the supply-driven rally that starts after index rebalancing completes? The answer is obvious when you understand how institutional money actually operates versus how retail investors react emotionally to price movements. 7 major banks, institutions that provide commodity market making and vault services to sovereign wealth funds and central banks, are predicting that supply deficits will widen significantly in 2026, according to precious metals, market analysis tracked across multiple financial research platforms. These aren't promotional websites trying to sell you silver coins. These are the same banks that provide liquidity to industrial manufacturers who need silver for actual production and can quantify real-world demand against available supply. Let me walk you through the supply math that has Wall Street positioning for triple-digit silver. Global silver production from mining and recycling provides roughly 1 billion ounces annually. Industrial demand from electronics, solar panels, semiconductors, and electric vehicles consumes approximately 600 million ounces. That's 60% of total production, going to applications where silver cannot be substituted without redesigning entire manufacturing processes. Investment demand from coins, bars, and ETFs adds another 250 to 300 million ounces. That's 850 million to 900 million ounces of documented demand against 1 billion ounces of supply, leaving only 100 to 150 million ounces for jewelry, silverware photography, and emerging applications like water purification and medical devices. The market is already running deficits every year, drawing down above-ground stockpiles that took decades to accumulate. Now China implements export controls on 60 to 70% of refined silver supply, creating allocation uncertainty for Western manufacturers. Solar panel producers in Germany and the United States suddenly can't rely on Chinese silver exports. Semiconductor fabs in Taiwan and South Korea need to compete for shrinking allocations. Electric vehicle manufacturers building battery systems requiring silver-based components face a supply chain disruption. What happens to price when supply gets restricted during an existing deficit? You don't need a PhD in economics to understand that equation. But here's what separates sophisticated institutions from retail investors getting crushed in this environment. Institutions aren't buying SLV shares or COMEX futures contracts that settle in cash. They're converting to allocated physical storage in London and Singapore vaults, documented through wholesale dealer reports tracked by financial content and precious metals industry platforms. Allocated storage means specific bars with serial numbers assigned to your account, not pooled inventory that 10 different investors might have claims against. Why does this matter for your investments? Because when supply shortages become severe enough, futures markets can declare force majeure and settle contracts in cash rather than physical delivery. The COMEX has done this with other commodities when physical supply couldn't meet contract obligations. If that happens with silver, your futures contract or ETF shares get cashed out at whatever price the exchange determines is fair value. which will be substantially below what physical metal trades for in the real world. This is exactly what happened with lithium and certain rare earth elements when China restricted exports. Paper markets collapsed, while physical material traded at massive premiums in spot markets where actual supply and demand determined price. Institutions holding physical allocations made fortunes. Investors holding paper got pennies on the dollar. The $74 crash isn't the market rejecting silver's value. It's institutional money, exploiting mechanical selling and regulatory structure to shake out weak hands before physical supply constraints force the next phase of this market. And based on Vault Inventory's export restrictions and supply deficit math that 7 major banks are quantifying for their institutional clients, that next phase is targeting prices that will make the $84 peak look like the bottom of a much larger move. The question is whether you understand the difference between paper silver and physical silver before that distinction becomes the most expensive lesson in your investment portfolio. Let me give you the exact timeline and targets that institutional money is positioning around, because this is not speculation anymore. It's calculating inevitable outcomes based on documented supply constraints and mechanical market structures that have already been set in motion. January 15th, 2026. Mark that date on your calendar, because that's when Bloomberg Commodity Index rebalancing completes, marking the end of forced mechanical selling that crushed silver from $84 to $74 in 48 hours. After that date, there's no more automatic liquidation pressure. The selling that Wall Street knew was coming for months finally stops. And that's when institutional smart money that accumulated physical metal during the crash positions for what happens next. But here's what makes this moment different from typical market corrections. We're not dealing with a temporary demand shock or a cyclical downturn that reverses when sentiment improves. We're facing structural supply constraints that compound every month. China maintains export controls, while industrial demand continues consuming 60% of annual production with zero viable substitutes for the majority of applications. According to Precious Metals technical analysis tracked across multiple commodity research platforms, first resistance sits at $80, basically recovering the losses from the mechanical sell-off. But here's where the math gets interesting for anyone thinking about portfolio positioning over the next 6 to 12 months. February through March, as index rebalancing effects fade and physical supply tightness becomes visible in industrial purchasing channels, silver recovers toward $80. Manufacturers start reporting extended lead times for silver delivery. Spot premiums in Asia remain elevated above COMEX pricing, confirming that physical markets have diverged from paper contract settlements. By Q2, if China maintains or tightens export allocations as geopolitical tensions continue, and remember they just elevated silver to strategic resource status for exactly this purpose, industrial consumers face a choice: pay premium prices for spot metal or risk production delays in government-mandated technologies like solar and electric vehicles. That's when $100 becomes not just possible, but necessary to clear the market and allocate scarce supply to highest value uses. Think about this scenario for your investments. A major solar manufacturer in Germany or the United States faces production delays because they can't secure silver allocations from China's restricted export channels. News breaks that electric vehicle battery production is being constrained by silver shortages in specialized components. Semiconductor fabs that produce the chips for everything from smartphones to data centers report that silver supply constraints are creating bottlenecks in advanced packaging processes that cannot be redesigned quickly. What happens to silver price when industrial demand that cannot be substituted starts competing for shrinking available supply, while exchange-traded products and retail investors are already depleted from the January shakeout? $150 per ounce becomes possible by year-end if supply deficits widen as 7 major banks predict in research compiled across precious metals analysis platforms. That's not hype. That's institutional commodity desks calculating what happens when structural deficits meet export restrictions during a decade where renewable energy and electrification are government-mandated policies consuming silver at unprecedented rates. Here's why those targets aren't speculative. Solar panel installations are projected to grow another 40 to 50% in 2026. According to International Energy Agency forecasts, each megawatt of solar capacity requiring approximately 20 kilograms of silver with no economically viable substitute that does not sacrifice efficiency or lifespan. Electric vehicle production continues ramping toward government mandates in Europe, California, and China, with each EV using 25 to 50 grams of silver in various electrical components, battery management systems, and charging infrastructure. These aren't discretionary purchases that consumers can delay when prices rise. If China reduces silver exports by 50%, well within their capability since they control 60 to 70% of refined supply, global deficits would exceed 5,000 metric tons annually, compounding existing shortfalls that are already drawing down above-ground inventories, according to supply-demand analysis tracked by Ainvest and Effect Street Commodity Research. 5,000 metric tons might sound abstract, so let me put this in perspective. That deficit equals approximately 160 million ounces annually that industrial manufacturers need but cannot obtain through normal supply channels. Solar panel production that requires 20% of global silver demand, according to industry consumption data, suddenly faces allocation rationing. Semiconductor fabs that need silver for specialized electrical contacts and bonding applications have no quick substitutes without redesigning chip architectures that took years to develop. Have you noticed what happened with lithium prices when battery manufacturers realized supply couldn't keep pace with electric vehicle mandates? Or what happened to rare earth prices when China restricted exports and Western defense contractors scrambled to secure materials for missile guidance systems and jet engines? Silver is following the exact same playbook, except the industrial demand is even more concentrated in technologies that governments have mandated for climate policy and energy transition. The permanent supply shock creates conditions where physical delivery becomes the price benchmark, not futures contracts. This is exactly what happened with lithium and rare earth elements when China weaponized supply. Paper markets collapsed into irrelevance, while spot transactions for actual physical material set prices at multiples of where derivatives traded. According to the Bank for International Settlements, commodity market research, when physical supply becomes constrained enough relative to derivative market size, exchanges face a choice: force physical delivery and expose that supply doesn't exist to settle contracts, or declare force majeure and cash settle positions at prices that devastate anyone holding paper. Either way, the disconnect between paper and physical becomes a wealth transfer from investors who didn't understand the difference. Now let me show you who's positioned on which side of this transfer, because the evidence is documented in wholesale market flows, tracked by financial content and precious metals industry platforms. Retail holders of paper silver, SLV shares, futures contracts, unallocated storage accounts are getting crushed by mechanical selling during this January liquidation event. You watched your positions drop 12 to 15% in 2 days, while financial media blamed only profit-taking and technical correction. Meanwhile, institutional money is converting to allocated physical positions before liquidity disappears in spot markets where actual metal trades hands. Wholesale dealers report that physical demand spiked during the crash, with premiums increasing as buyers competed for available inventory, while futures markets printed $74 prices. Large bars with London good delivery specifications, the 400-ounce bars that institutional vaults accept, were being accumulated by sophisticated buyers who understood that the disconnect between $74 futures and $80 physical prices in Shanghai represented a historic opportunity created by mechanical selling that had nothing to do with fundamental value. That's not a coincidence. That sophisticated money understanding that the $74 crash is not the end of this story. It's Wall Street shaking out weak hands before supply reality forces triple-digit prices that make current levels look like the opportunity of this decade. These institutions have commodity analysts, direct relationships with refineries and miners, real-time visibility into industrial demand, and crucially, they read the same Bloomberg Index methodology documents in November that told them exactly when $5 billion of mechanical selling would hit the market. Think about the psychology of what just happened to retail investors, because this is where emotional reactions create wealth transfers to analytical positioning. You bought silver believing the fundamentals about supply deficits and industrial demand. You watched it climb to $84, validating your thesis. Then it crashed 15% in 2 days, triggering stop losses and margin calls, forcing you to liquidate at $74. Financial media published articles about silver's bubble bursting and momentum trade ending, confirming your fear that maybe you were wrong about the fundamentals. You sold at the bottom of mechanical liquidation that had nothing to do with fundamentals and everything to do with index rebalancing that sophisticated institutions knew was coming for months. Now ask yourself, Who bought your silver at $74 when you panic sold? Who had the cash position and market intelligence to accumulate during forced liquidation? The same institutional desks that quantified 13,000 COMEX contracts being sold, positioned ahead of the event, and are now holding physical allocations, waiting for the supply crisis that China's export controls guarantee within 6 to 12 months. But here's what should empower you rather than frighten you, because knowledge is the only advantage that matters in markets designed to extract wealth from uninformed participants. You now understand the mechanism. You now see how institutional money exploits mechanical market structures, regulatory processes, and strategic resource controls to position ahead of moves that retail investors react to emotionally rather than analytically. This playbook isn't new. It's been executed in oil during OPEC supply cuts and natural gas during European energy crises and lithium during the EV battery rush, and in rare earths, when China first demonstrated the power of export controls against Western defense contractors. What makes silver different is the convergence of government-mandated industrial demand that cannot be delayed, strategic export restrictions from the dominant supplier, and a derivatives market that's 100 times larger than available physical supply. That convergence creates conditions for price dislocations that dwarf what we've seen in other commodities. The question isn't whether silver crashed. It did, and it might experience additional volatility if macro conditions deteriorate or if technical selling creates short-term pressure. The question is whether you understand what caused the crash, who positioned for it, and what the supply-demand math dictates happens next when $5 billion of forced selling stops, while China's export restrictions create permanent shortages in a market already running 7 consecutive years of deficits. According to World Gold Council research on precious metals markets and commodity cycles, the biggest fortunes in resource investing are made by those who understand the difference between price and value during forced liquidation events. Price is what nervous sellers accept when mechanical selling or margin calls force them out of positions. Value is what physical metal trades for when industrial manufacturers need it for production that cannot be substituted or delayed. That gap between $74 futures and $80 physical prices in Shanghai during the crash, that was the market showing you in real time what happens when paper contracts diverge from physical reality. Remember that scenario from the beginning? You watching silver climb to $84? Feeling confident in your investment, then watching it crash to $74 in 48 hours while mining stocks plunged and your portfolio bled? That was the wealth transfer in action. Retail investors experiencing the crash emotionally while institutional money positioned analytically for what comes after the mechanical selling completes. But only physical holders survive when paper markets break under delivery pressure that China's export controls are designed to create. This is not about predicting the future. It's about calculating inevitable outcomes when structural deficits meet weaponized supply chains during mandatory industrial transitions to technologies that cannot function without silver. The $74 price isn't silver's real value. It's the price that emerged when $5 billion had to be liquidated in 2 weeks regardless of fundamentals, timed perfectly with China restricting the majority of global refined supply. Wall Street understands this distinction. The question is whether you do before the next phase of this market makes that distinction the most expensive lesson or the most profitable insight of your investment career. Because 6 to 12 months from now, when physical silver trades at premiums that dwarf where COMEX futures settle when industrial manufacturers bid against each other for allocations that China controls. When solar manufacturers and semiconductor fabs face production delays that make headlines across manufacturing sectors, you'll remember this moment when silver crashed from $84 to $74, and you will understand whether you positioned with the institutions who saw it coming or with the retail investors who sold at the bottom of a manufactured liquidation event. The institutions managing billions in commodity exposure aren't gambling on silver hitting $150. They're calculating what happens when you combine 7th consecutive year of supply deficits, 60% of production consumed by industrial applications with 0 viable substitutes, export controls on 60 to 70% of refined supply, government mandates requiring unprecedented solar and EV production, and a paper market that's 100 times larger than physical deliverable inventory. That calculation leads to one inevitable conclusion. Physical silver becomes worth whatever industrial manufacturers must pay to keep production lines running when China rations exports, and above-ground stockpiles continue depleting. You're watching this calculation play out in real time. The January crash was Chapter 1, mechanical selling creating the disconnect between paper and physical that institutions exploited. Chapter 2 begins after January 15th, when forced selling ends and supply constraints become the dominant narrative. Chapter 3 arrives when the first major industrial manufacturer publicly announces production delays or supply shortages, validating what institutional commodity desks have been positioning for since November, when they read the index rebalancing schedule and saw China debating export control legislation. The wealth transfer is happening right now. The only question is which side of it you're on. Are you the retail investor who sold paper silver at $74 during mechanical liquidation? Or are you the informed participant who understands that this crash was engineered, predictable, and documented in regulatory filings weeks before it happened? Are you holding paper contracts that settle in cash when supply shortages create delivery failures? Or do you understand why institutions are converting to allocated physical positions before that distinction becomes the most expensive lesson in commodity market history?